Hey everyone, I am going to walk you through my solution to the corporate tax return. Um, and I was pretty impressed by the work that most of you did on the returns. And it looked like you put a lot of effort and thought into it. Um, and so thank you for that. I did think it was a good idea, though, to post a lecture so I can kind of walk you through live rather than just giving you the tax return in case some of you don't understand why certain lines should be what they're supposed to be. So, first of all, remember that the tax return is on a tax basis. So what you're supposed to be presenting on page 1 of the 1120 for a corporation is their tax income statement. So essentially it's their book income statement adjusted for book tax differences. And if we go to the financial information that I gave you, the reason I gave you the information in the format that I did was I was hoping that you guys would jump with this and create, post your book tax differences and then create a tax income statement that would tie to your tax return so that you could show your support for what's on the tax return. And if some of you end up going into practice where you start preparing tax returns for a living, you will have to have support for what's on the tax return. And you should save that report for as long as you save the client's tax return so that if the client is ever audited, you have a way to go back and show the IRS or show the state authorities how you came up with certain numbers. And so we typically call the support our work papers. And this Excel workbook is representative of what the supporting work papers for a corporate tax return might look like. The client, you normally request information from the client, and in our case, we got certain information from the client. We got an audited balance sheet, which obviously everything on here is on a book basis because it's their audited balance sheet. So it's if they were a public company, which AMI is not a public company, it's a closely held company owned by two individuals. So we know it's not a publicly held company that has to report to the Securities and Exchange Commission every year. Nevertheless, many banks will require a company to provide financial statements that have been audited or at least reviewed by an accountant each year. And that's so that they get some comfort on what the income and the debts and the equity of the corporation actually are. Because when the company takes a loan out from the bank, they represent that their income has been a certain amount, and they represent that going forward it will be a certain amount. And that gives the bank comfort enough to be able to provide a loan to that company. So as a prerequisite for that, they require every year, as a condition for giving them a loan, they require every year for the company to provide the bank with audited financials. So that's one of the main reasons that companies will hire accounting firms to review and or audit their financial statements. So I've told you in these facts that you have an audited balance sheet, and I tried to present this. I actually took some time to present this in a SEC format, or what's sometimes referred to as a 10K format. So a 10K is the form that's filed with the SEC for a public company, which presents, basically it's their annual report with an emphasis on the audited financial statements and notes thereto. So I took some care to actually provide this in sort of a 10K format, the way that it would look on a Form 10K. This is what the balance sheet would look like. It would typically be a 2-year balance sheet. Typically, the latest year is on the left and the earlier year is on the right. And these are typically the categories that would be presented. And then the audited income statement, this is in more detail than you would typically have if you were presenting this in a Form 10K to the SEC. A lot of these items would be combined, and you would have like a general and administrative G&A expense category that would encompass many of these expenses, because if they're small, then they're deemed too immaterial to be presented by themselves. But in our case, I presented it in enough detail so that you could prepare a tax return from it. The other income detail was simply given to you on a book basis by the client in our fact pattern. So AMI gave us this other income detail, which that $10,000 ties up to other income on this next tab right here. And the reason that you would have asked your client for this, you, the tax return preparer, would have asked someone from AMI for this, is because you would have looked at this $10,000 and you would have said to yourself, what is this $10,000 comprised of? And so I told you that it's comprised of a capital gain of $8,000 and a gain from disposition of fixed assets of $2,000. Further, I told you in the Word document that I gave you that I told you that, let's see, they sold equipment for $10,000 of cash. It was originally purchased for $12,000, and through the date of sale, they had recorded a cumulative total of $4,000 of book depreciation. And I capitalized book depreciation for you. Hint, hint, right? And I capitalized the fact that they had accumulated $6,000 of tax depreciation. So then what you were supposed to do was calculate both your book gain and your tax gain, and then make sure that you understood where on the income statement the book gain is located. Why? Because you need to reverse that for tax purposes, for tax return purposes, and substitute it with your tax gain. So when you calculate the book gain, it's simply proceeds minus your book adjusted basis. Your book adjusted basis is $12,000, which is the original cost, minus the accumulated depreciation of $4,000, which is $8,000. So your adjusted cost basis for books is $8,000, and you got proceeds of $10,000. So your net gain is $2,000, 10 minus 8. And lo and behold, when you go back to the information, there's the $2,000. Now we know it was included in other income. And we also know from our facts that the $8,000 was included in other income, and that represents the capital gain associated with with the sale of some stock of Simon Sheet Music. So they sold 2,500 shares of Simon Sheet Music stock for $33,000 of cash. And it had originally been purchased several years ago, 10 years ago, for $25,000. So 33 minus 25 rather, is 8. That's the 8, that's the capital gain, or the gain. There's no such thing as a capital gain for book purposes, because they don't distinguish for book purposes between capital gains and ordinary gains. It would just be called a gain on your books, and it's $8,000 for book purposes. So I gave you these facts for two reasons. One, I wanted to let you know that they sold some stock, which is a capital asset. They realized an $8,000 gain. And you guys know from what you've read before and what we've talked about that typically with a stock purchase, there is no book tax difference in the cost basis of stock that's purchased because it's purchased for cash. And it is what it is. Cash is cash, right? So the tax basis of this stock that was sold is also $25,000. So the tax gain is also $8,000. So you now know you have no book tax difference. The other reason I gave you these facts was to let you know that after the sale, AMI only owned 12.5% of Simon's sheet music. And I wanted you to know that because you guys actually got on your income statement, if you look on your income statement, there's actually dividend income of $12,000. And you have to decide whether you get a dividend received deduction for that. And we know that for companies that we own less than 20% of the stock, we get a 70% dividend received deduction. And so if you read carefully here, you would know that after the sale, they only owned 12.5% of Simon Sheet Music. So that's why they get, and actually before they sold it, they only owned 15% of the total stock outstanding of Simon Sheet Music Company. So even before they sold it, they still would only get a 70% dividend received deduction. So there were two reasons why I gave you those facts laid out like that. But remember, and some of you guys kind of missed this is on a book basis, and this was given to you by your client, AMI, so that you would understand what the breakdown is of this $10,000 of other income on their book statement. And then you would say from that, okay, well, I know that I have no book tax difference associated with the capital gain of the stock, but I do have a book tax difference associated with the sale of the equipment. Because with regard to the sale of the equipment, if we go back up here, they sold it for $10,000 cash. Our book basis, we know, is $8,000, but our tax basis is $12,000 minus 6, or $6,000. So our tax gain is $10,000 minus the $6,000 tax basis, and so our tax gain is $4,000, whereas our book gain was only $2,000. So we have a $2,000 book tax difference associated with this sale of equipment. And that means we're going to have $2,000 more of income for tax purposes than we did for book. So I should have seen on your tax return on line 9, I should have seen a $4,000 tax gain. Whereas for books, it would be $2,000. Okay? But remember, I'm not presenting things here on a book basis. I'm presenting things here on a tax basis. And to the extent I have book tax differences between my book income statement and my tax income statement, what do? I show a reconciliation from book income to tax income of all of my book tax differences. So everything, line 1 is just supposed to tie to your books, your book income. So my book income is $568,000. So on my tax return, we should see on line 1 of Schedule M1 and also on line 2 of Schedule M2, net income per books is $568,000. And then on lines 2 through 9, I list all of my book tax differences. The differences between my book income statement and my tax income statement. Okay? And whatever's on line 10, that has to tie to page 1 line 28. So I come up with taxable income of 818,500, and if you go to page 1, line 28, there's my 818,500. Now notice that I also have a special deduction, which is my dividend received deduction that I get. Remember my 70% dividend received deduction I get, that I get to subtract from my dividend income. So my total dividend income from that Scheinman's sheet music is $12,000. But if I go to the next page here of the return, this is Schedule C. This is where you list all of your dividends received. So these are dividends that the company, AMI, receives from other companies that it owns stock in. You cannot get a dividend from somebody unless you own stock in the company. So at least one of you got confused between dividends that are paid by AMA to its shareholders, and who are AMI's shareholders? Alvin and Fiona. Those are the two shareholders of AMI, this company whose return we're preparing. So those two individuals who own AMI got in total $80,000 worth of dividends. How do I know that? It was in my facts. Somewhere I told you guys this. AMI paid a dividend of $80,000 to its shareholders on December 1st. AMI had ample earnings and profits to absorb the distribution. Now, the reason I gave you that second sentence was so that you wouldn't think that you had to fill out a special form that Schedule K, and I'll show you this. I'll show you on Schedule K. There's a question that says, during this year, did the corporation pay dividends other than stock dividends and distributions in exchange for stock in excess of the corporation's current and accumulated earnings and profits? And if it did, then it's supposed to file a Form 5452. And I didn't want you guys to think you had to fill that out. I didn't tell you had to fill it out anyway. But I didn't want someone to get all freaked out and think that they might have to do this, or make an assumption that they had to do it and then spend the time trying to figure out how to do it. Because actually you weren't even given enough information to fill out the form correctly. Okay, so, but that was why I gave you that information there. Okay, so if I were doing a tax return for AMI, this is what I would do. I would start with the client's Excel workbook of information that they gave me, and I would create a tax income statement from it. And this detail here, I would make sure all gets transcribed onto my tax return in some way, shape, or form. Now, I would also do groupings here so that in the end, the format of this in column G, this tax income statement, it would actually be in the same order and format as my tax return, page 1. So I would have sales on the first line, my returns and allowances on the second line, etc. Whereas right now, if you look at this, you will notice that some of these expenses down here, more than one line item of these expenses, we are going to need to put in other deductions, which is line 26 on our tax return. So I normally would group these, or tell my staff to group these, and grouping them means add them up, and then have a check total that would add up to the total other deductions that would tie to the return. And you would do that for every line item. So you would basically, you would start with this book income statement, and then you would probably do a bunch of groupings here, and then you would come up with new line items over here that would tie to page 1, 11, 20, and then you would post your M1s. You would show your M1s. Now, we call them M1s in the accounting industry. Why? Because Schedule M1 that I just showed you on page 5 is your book tax reconciliation. And lines 2 through 9 are your book tax differences. And we typically call those Schedule M1s or Schedule M1 adjustments. Okay? So that's the lingo that we use. So I would typically do like set up a debit and credit thing, and I would list all my M1s here. If they were debits, mean they're going to reduce my taxable income, so they are reductions from they're reductions from a debit. A debit means that it's going to be a reduction from your revenue, but it's actually going to increase your expenses, correct? Because expenses are natural debits already. So if you have something else in the debit column, it's going to increase this expense over here. If you have something in the debit column up here on revenue, it's going to decrease your revenue. We actually don't have any M1s or any book tax differences between revenue from sales for book purposes and revenue from sales for tax. Same with the returns and allowances, no book tax differences. Same with cost of goods sold, no book tax differences. So this is what I wanted to see on your return, and most people had this on their return. Now, going down to the expenses, no book tax differences between compensation for books and compensation for tax. Now, one, not mistake, but I'll call it a flaw in my information that I gave you, is that I gave you guys officer's comp, which you would typically request from the client, because typically what's on your income statement is just this line item called compensation or salaries. And within this, included in the total salaries are the officer's compensation. And we need a separate breakout of officer's compensation, because on page 1 of the 1120, there's 2 line items for salaries. There's a line item for officer's compensation, and then there's another line item for everybody else's salaries. Now, notice in my solution that I have total officer's comp of 600,000 and salaries of 7. I rewrote the assumptions. This is from last semester. So actually what your tax return should have looked like is it should have had the whole 1,000,003 on line 12. And I would say 95% of you had the correct answer here. Nothing should be on line 13. Because line 13 would be for salaries of non-officers. And I told you in the facts, because you got this from the client, that the total salaries are all from officers. Now, how likely is it that you're going to have a corporation where everybody is an officer? Usually you're going to have at least one poor employee that's not an officer, he's just a worker bee, right? So that's what I'm saying. This is kind of a flaw in the way I presented the info. I kind of forgot about that fact. I should have made this add up to maybe like $1 million and then had like $300,000 worth of salaries that was just for other employees. So then you would have had $1 million on the officer's comp line of your tax return, and you would have had $300,000 in line 13. But whatever, most of you got this right, that it should be 1,000,003 because that's the info I gave you, and there are no book tax differences with regard to officer's comp. Okay, so moving on down the line here, when we get to bad debt expense, most of you got this wrong. There were a few people, 1 or 2 people that got this right. Here's how you calculate this. First of all, the information I gave you with regard to bad debts is I told you AMI wrote off $10,000 in accounts receivable as uncollectible during the year. Okay, if you go to your chapter, to chapter 2, and actually, I'm going to go in here. I'm sorry, I should have had the book open. Now, of course, it's taking forever to open. Okay, so I think I go into tools, go into here, go into here. Maybe this is a good thing that we're going in here because some of you might have forgotten how to some of you might have forgotten how to open up your this is not working. Okay. This happened to me the other day too. I don't know why. I'll try one more way. Actually. Okay. Calculate deductions, particular. Yeah, I think this is where I'm gonna. Oh, it's telling me I need Flash Player. I don't know why. All right. Let me just tell you that in chapter 3, because I went back and looked at this today because I thought, oh, maybe bad debts weren't talked about in terms of book tax differences, so you guys wouldn't have known. But if you go into chapter 3, I believe it's in chapter 3, there's a whole list of book tax differences that they go through and discuss. And one of them is regard to, of course, now I can't find it. I just had it open earlier, you guys. One of them is with regard to bad debts. And the rule with regard to bad debts is that you are only allowed to deduct actual bad debts, not bad debts that were created through a booking to your bad debt allowance account, which is simply a contra receivable. It's a contra account to your accounts receivable. You're only allowed for tax purposes to deduct write-offs to the receivable. So if you deem a receivable to be uncollectible, you billed the guy, you billed the customer several times, and maybe even you found out the customer is bankrupt or they skip town and you just know you're never going to get that money back, you can actually write off the receivable. When you write off the receivable for book purposes, you are crediting AR, accounts receivable, and you're debiting the AR allowance. You are not debiting bad debt expense. So that $10,000 in our information that we were given, that $10,000 write-off did not hit bad debt expense. It did not get charged to the income statement. So you need to know that for tax purposes, you get a $10,000 bad debt expense. That's what you should put on your return. And you should reverse whatever they have on the book income statement. What the bad debt expense for book income purposes is $15,000. You should only be getting 10. So your book tax difference is $5,000. The other way you can arrive at this $5,000 M1 is, and this is how we typically do it. We do it through what's called the balance sheet method. We would take the beginning, the ending AR allowance, and we would subtract from it the beginning AR allowance. So 40 minus 35 is $5,000. We had a $5,000 increase to our AR allowance, and whenever during the year, and whenever the AR allowance is charged, in other words, it's credited, because remember it's a contra AR, so it's actually a natural credit account. So whenever something is booked to the AR allowance, It's credit AR allowance, debit bad debt expense. So because we know that there was a $5,000 increase to the AR allowance, we need to create an M1 for that $5,000. And we would actually, that would be our M1 would be $5,000, which would leave us still in this case with $10,000, because this would be your M1, which is basically the change in the AR allowance, and then your net tax bad debt expense would be $10,000. Like I said, most people got this wrong. I still marked you wrong if you didn't get it right, because it did talk about it in the book. But I don't really think it's going to change anybody's grade, because just about all of you got it wrong. Meals and entertainment. This was clearly in the book, and most of you got this right. Meals and entertainment expense is only 50% deductible for tax purposes. So you have to add back as an M1 adjustment the other 50%. So that's why you have a $2,500 add back here. So your net tax expense for meals and entertainment is $2,500. You can see that I'm just summing across here. So if there's no book tax difference, then column G equals column B. But I actually did, you can see I've got a formula here, right? Now down here in other expenses, I told you in the information that $3,000 of life insurance premiums were paid during the year on a policy for which the company is the beneficiary. And you know from your reading that those expenses are non-deductible. That's because if the company is the beneficiary of a life insurance policy on an officer, and that's what the case is here, and that officer dies, the company as beneficiary collects on the life insurance policy, and that those life insurance proceeds are they're excludable, they're tax exempt for tax purposes. They are not taxed. So that income would be reversed if that officer died and the corporation collected as the beneficiary on the proceeds. And because those proceeds are non-taxable, the expenses associated with the life insurance policy are also non-deductible. And that's discussed in the book too. So there is another $3,000 book tax difference. Now, when we get down here, we'll see that there's an $11,000 book tax difference between book depreciation and tax depreciation. Most of you got this right, but some did not. And it does talk about, I was pretty clear here actually, I kind of gave you guys the answer. I said regular tax depreciation was $31,000. All right, right now, you know that you're going to have, if tax depreciation, which is what goes on my tax return page 1, is going to be 31 and my book is 20, that means I have an $11,000 M1 adjustment to make. I also told you in the details that for both regular and AMT depreciation, the amount is $31,000. So therefore, you don't have an AMT depreciation adjustment. So when you do the form 4626, you should not have anything on line 2A. Many of you did. This is only for differences between regular and AMT depreciation. And I told you in the facts we don't have any differences. So you shouldn't have put anything here. Now, if you don't have any difference between between regular tax depreciation and AMT depreciation, then you're also not going to have any book tax differences upon sale of those fixed assets. And so you shouldn't have had anything on line 2E either. However, you should have had something on line 2M, because the way that it works, and let's go down here. So actually our next line item is interest income. Interest income for book purposes was $15,000. And then I told you in the facts I say of the $15,000 interest income, $2,500 was from City of Fremont, from a City of Fremont bond, so that's a muni bond, which we know is tax exempt, that was used to fund public activities. Okay, so we know it's tax exempt. And then we also have $3,500 that was from a Pleasanton City bond. So that's a muni bond also, so it's tax exempt for regular purposes. But it was used to fund private activities. And if you read the instructions for Form 4626, it tells you that tax exempt interest income from private activities is not tax exempt for AMT purposes. So you have to add it back into income. Remember that on line 1 here, you're starting with taxable income for regular purposes. These differences down here are things that you have not included in page 11120 that you need to include for 4626 purposes, for AMT purposes. Remember, I told you in my lecture that week when we were going through chapter 5, the AMT system is a system that's parallel to the regular tax system. It feeds off of it. It looks and feels like the regular tax system, but it feeds off of the regular tax system. So you start with regular taxable income, and then you go through and make sure you don't have any regular tax / AMT differences. And if you do, you got to list them on these lines. And you do have one down on the tax exempt interest income line from private activity bonds, because some of your tax exempt interest income was from private activity bonds. Most of you missed this. There were, I don't know, maybe 1 or 2 people got this right. Okay, and then it was imperative that you guys actually fill out the rest of the form. Most of it's just adding stuff down, you know, typing in your regular tax liability, which comes from Schedule J of your return. So if you go back to page 3, here's Schedule J. So Schedule J, and by the way, you guys, I think I don't remember if I got -1 or whatever on my project, but I forgot to fill out Schedule J on the upper part. I filled out the lower part, but I forgot the upper part, even though on page 1 I got the tax right, the tax liability right, but somehow I forgot to fill out Schedule J. Now, if you guys forgot, I gave you -1 because you really, I mean, I didn't tell you not to fill out any portion of pages 1 through 5. I told you to fill out pages 1 through 5. So every page should have been filled out. It's fairly easy. Line 2 is your income tax, which comes from tables in the 1120 instructions. It just says if your taxable income is between this amount and this amount, then, you know, it's this tax minus blah, blah, blah. Anyway, it's a table. It's an income tax table, kind of like you do use for your own tax return. So you were supposed to figure out your income tax. Then you were supposed to subtotal on line 4. Then you have no credits, so line 6 would be 0. Then you were supposed to subtract line 6 from line 4 and have something on line 7, which is your tax again. And then none of this applies to you down here. And you don't have any alt-min, by the way, no alt-min. So then your total tax is the same as what's on line 4 and on line 2. So basically, this is your tax. And then this tax gets transferred to page 1, line 31. It even tells you right here to transfer it. Some did, some didn't. You got marked off if you didn't do that. Okay, so part 2 was where you're supposed to list your payments that you made towards your tax liability during the year. And I told you that they made a total estimated tax payments of $280,000. I changed the facts a little bit since last semester, and I told you that they also paid $10,000 with their extension, which is the 7004. So line 16 should have also had $10,000 on it for a total of $290,000. And then that 290 gets transferred to page 1, line 32. Most of you got that right. Then Schedule K. Schedule K, most of you did this, and most of you checked the answers correctly. I didn't mark you off if you marked some of these yes, whereas they should have been no. Most of you just marked everything no, like all the way down the line. So I didn't take off unless you put no on line 4B, where it says, did any individual or estate own directly 20% or more of the voting power of all classes of the corporation stock entitled to vote? Well, that answers yes, because Alvin owns 60% and Fiona owns 40%. And if that's the case, if the answer is yes, you're supposed to complete part 2 of Schedule G. It tells you right here, part 2 of Schedule G. It doesn't tell you part 1 of Schedule G. Some people filled out part 1. And some people filled out part 1 and part 2. Only part 2 was supposed to be filled out, where it says certain individuals and estates owning the corporation's voting stock. And then you're supposed to list them. Alvin owned 60, Fiona owned 40. They want to know this because, there's several reasons. It's just a transparency thing for the IRS to know who owns the company. Because there's certain rules around closely held corporations that could affect, it could affect both this corporation's return and the income tax that they pay, and it could also affect the closely held shareholders, corporation shareholders. So this is a transparency form that was started several years ago. I think it might have been 2011. It hasn't been around more than like 5, 6, 7 years. The IRS several years ago, actually starting back in 2005, it started adding forms to the returns to increase transparency, to increase their look into the taxpayer's business. It wanted to get into and understand more of what the corporation has and does, because they wanted to make sure that they're complying with the rules. So they added forms, and this is one of them that they added. They used to just have, it used to be that you would just answer Schedule K, you would answer yes here, and then that was it. There would be nothing to fill out if you did own 50% or more. Actually, I take that back. I think actually you were supposed to list it. I think it would say include a statement, like a white paper statement, and then they changed it. Now it's an actual form. Okay, so that's that. So I did mark you off if you didn't get that right. And then I also gave you 1 point off if you forgot these 2 items, items 9 and 10, because it was so easy, you guys. Enter the amount of tax-exempt interest received during the year, $6,000, right? It's the $2,500 plus the $3,500 from those bonds. And then enter the number of shareholders at the end of the year if 100 or fewer. And that's because they want to know if you have a closely held corp. So in this case, we have 2. So I marked you guys wrong if you didn't mark that in. For the balance sheet on page 5, you got marked wrong if your balance sheet didn't balance. Like, that's just a huge no-no. Your total assets must equal your total liabilities and shareholders' equity, both at the beginning of the year and at the end of the year. So if your balance sheet didn't foot, meaning it didn't add up, or if it didn't balance, meaning assets didn't equal liabilities and shareholders' equity, you got marked down. Also, this is on a book basis. It's not on a tax basis. So no adjustments should have been made to this balance sheet. It should have been pretty easy to basically just take this balance sheet here and transcribe it right onto page 5 of your 1120. Schedule M1, I required you to fill out. Schedule M2, I required you to fill out. Some people did not fill out Schedule M2, so they got marked off 1 point for that. Because it's, first of all, it's pretty easy. Line 1, Schedule M2, should always tie to your beginning of the year retained earnings, line 25. Line 8, your balance of your retained earnings at the end of the year. So you notice how this says analysis of unappropriated retained earnings per book, line 25, Schedule L. It's a reconciliation that helps us get from the beginning of the year retained earnings to the end of the year retained earnings. Notice how my amounts tie. Most of you guys got this right, but some people just put the beginning and ending numbers and forgot about the net income per books of 568, and they also forgot about the dividend distribution. The worst thing about doing that is this analysis didn't foot. It didn't add up, right? 3,170,000 minus nothing, minus 0, should have been 3,170,000, but it's not. You guys put 3,658,000 as your ending. So then you should have known, oh, something's wrong. What goes in the middle? And then you would have seen, oh yeah, that's right, net income per books. Well, that's easy. That's 568,000. Where did I get that from? Right there, net income per books, right? And then you would have said, well, I'm still $80,000 off. Well, in your information here, I told you somewhere, I told you that AMI paid a dividend of $80,000 to its shareholders. So that $80,000 dividend goes on your Schedule M2 as a dividend distribution. And remember when I first started talking today, I told you that the second reason I gave you this information is for Schedule K purposes, so that you would make sure to know that you wouldn't have to mark yes on that Schedule K question, which would require you then to fill out a Form 5452. That's why I gave you that info. 2 reasons: Schedule M2 purposes and Schedule K purposes. Okay, so let's go back to the return. So that I did require you to fill out Schedule M2. You got marked off 1 if you did not fill that out correctly. Schedule M1 had you had an ability to miss more than 1. Some people got like 5 or 6 or 7 points off for this. Net income per books, line 1, pretty easy, should have been 568. Line 2, federal income tax per books. It's non-deductible for tax purposes. Federal income tax is not deductible for tax purposes. It tells you in that book, and it also tells you right here to add it back. Right? And then if you looked in your instructions, it would tell you to put it because it's non-deductible. Then, do you have any excess of capital losses over capital gains this year? No, you don't. You have a capital gain of $8,000 from the sale of the Simon sheet music stock. But you don't have any capital losses in excess of the $8,000. So you have nothing to put here. You have no add back. On line 4, however, you do have a $2,000 M1, and that's now where you should be taking all of this stuff from or getting it from is from your support. If you already have typed it in here in your Excel workbook, then you have to just figure out, what all your M1s are now. You just have to figure out where on the Schedule M1 schedule on 1120 to put them. The $2,000 goes here. The $2,500 of non-deductible meals and entertainment goes on 5C. And also on 5C in the write-in line goes your 2 other add-backs to income for non-deductible expenses. Expenses recorded on books, not deducted on this return. Well, you had $3,000 worth of life insurance premiums that were non-deductible, plus you had $5,000 worth of bad debt expense, which was non-deductible. So in total, the 2,500 plus the 3,000 plus the 5,000 equals 10,500. Moving over to the right side of the schedule. By the way, everything on the left side of the schedule is supposed to be an add back, an increase to taxable income. Everything on the right side of the schedule is supposed to decrease taxable income. One decrease to taxable income is your $6,000 of tax-exempt interest income. Another decrease to taxable income is the $11,000 of depreciation for tax purposes in excess of what you expensed for book purposes. For book purposes, book depreciation was $20,000, but for tax, I told you in the facts, I just gave you it as part, it was a gimme. I told you it was 31. So 31 minus 20 is 11, and the 11 goes right here. And then you also need to type something in the write-in line under 8B, and that's for your capital loss carryover from the prior year of $5,000. You're going to use that this year, and you're going to offset it against your $8,000 capital gain. So you will end up with a $3,000 net capital gain on the tax return. And so then when you total up all that stuff, it comes up to $18,500. And as I told you before, that actually ties to line 1. Page 1, line 28. Then your dividend received deduction goes on line 29B. That's the 70% deduction that you get from the $12,000 of dividends that were received from Simon Sheet Music. And so your net taxable income after special deductions is $810,100. The tax on that is $275,434. Your total amount paid during the year is $290. Ignore my thing. It's actually $290. So your overpayment should have been $14,566. Okay? All right, what else do I need to show you? Here's what Schedule D should have looked like. $5,000 capital loss carryover goes on line 6, and the capital gain from the sale of the stock goes on line 8A. So that nets down to $3,000, and then it tells you here, put the $3,000 on the correct, on page 1, Form 1120, page 1, line 8, or on the proper line of other returns. So this form is actually used for other returns as well, and so it might be a different line if it wasn't an 1120. So that's what your Schedule D should look like. Schedule G, I think I showed you, should just have Part 2 filled out. Some of you put, I think one person actually, put something on, 2 people put something on Part 1. They got confused. This is where you list entity owners. So if there are owners of AMIs if there are entities other than individuals who own some of AMI's stock, and it has to be 20% or more directly or 50% more indirectly, then you would list them here. Like if a C corporation or if a C corporation owns some stock, or an S corporation owns some stock, or a partnership owns some stock in AMI, you would list that ownership up here. You'd list the name of the entity here, their EIN here, the type of entity, whether it's partnership, corp, whatever, here, country of organization, and then the percent owned. And as I said before, Schedule G is a transparency form. 1125A. The 1125A is supposed to be the detail behind cost of goods sold. This used to be a schedule that was shown on page 2, either page 2 or page 3 of the 1120. But then what they did was they increased the number of questions on Schedule K from about 1 page to 2 pages. Now it's like a full 2 pages. And so when they did that, and they also increased Schedule J from like a quarter of a page to a half a page. It takes up, over half a page now. So when they did that, they had no room for the cost of goods sold schedule that used to be incorporated as part of the 1120. So they created a separate schedule for it, but it still looks the same. So I asked you guys to fill this out. I told you in the facts that they had bought 1,134,000 of inventory during 2016. And I also told you that they valued their closing inventory at lower of cost to market, and I told you to assume that the rules of 263 Cap A do not apply. The reason for those last 2 bits of information was so that those of you who wanted to actually fill out the form a little bit more accurately, you'd have the wherewithal to actually mark. And actually, last semester it was cost was in the information. I changed it to lower of cost for you guys, and then the answer to here to 9E is no, because no, the rules of 263 Cap A do not apply. And then you guys wouldn't have known what to answer for F, but most, I didn't give you that in the facts, but I just made an assumption when I did the return that it was no. But the important part, what I marked you down for, was not the questions, but if you didn't even fill this out, or if it didn't foot, I marked you down, because inventory at the beginning of the year is just supposed to tie to your beginning inventory per your balance sheet. Same with ending inventory. It's supposed to tie to your ending inventory per the balance sheet. You already know what cost of goods sold is, because there is no book tax difference between book cost of goods sold and tax cost of goods sold. So you already know it's 834, because that's what it is here. So then what's left? What's left is line 2, purchases. This thing will not foot unless you have something stuck in either line 2, 3, 4, or 5, because otherwise it doesn't foot down. So I already told you in the facts that 1,134,000 of purchases was made, but really you didn't even need to know that fact, because you could have just plugged. Usually purchases is just plugged, meaning it's the fallout number. It's the number that makes this schedule foot after taking into account book tax differences, of which we have none. So you did get marked down if you didn't get all those lines right, because I felt like that was pretty easy. Just about everybody got the officer's comp schedule correct. I gave you officer's comp in your facts, so you were just supposed to put all this stuff in. By the way, you can't follow this because it's changed since last semester. I changed the facts, so. But I think just about everybody got that right. So I think I've walked you through everything right now. I guess if I had to recap, the things that most people got wrong was the bad debt expense. They didn't understand how to calculate tax bad debt expense. A couple of you got confused and thought that this page 1, 1120 was supposed to be on a book basis. You could tell because everything was on a book basis. There were no M1s posted, no book tax differences reflected, rather. So, oh, and there were a handful of you who were thoughtful enough, I'll call it, to actually try to calculate a domestic production activities deduction and put something on line 25. I didn't mark you down if you had something on line 25, but let's think about this. This is a music supply store. They are a retailer. It doesn't say anywhere in your facts that they make sheet music or they manufacture flutes or guitars or anything like that. It simply says that they sell products. So they're a retailer. And if they're a retailer, they're not manufacturing anything. They're not producing anything for sale, so they can't even take advantage of the domestic production activities deduction. So they get no deduction for that. So you shouldn't have had anything on that line. But that's just, hopefully that explanation makes sense as to why you wouldn't have anything on that line. All right, I think that's about it, you guys. If you have any questions, let me know. But again, good job. Most of you did great. And I'll talk to you soon.